Good morning. Thank you for joining us. My name is Sarah Campbell. I am one of the marketing coordinators here at Squire and Company, and I am excited to introduce our presenters to you today. We have two presenters. We have Megan Bronson and Brandon Allfrey. Megan is a CPA, and an advisory partner at Squire. She has over a decade of experience working with businesses across several industries, specializing in QuickBooks consulting and outsourced accounting services for manufacturing and distribution clients. Brandon Allfrey is a CPA and tax partner at Squire. He focuses on individual and business tax planning, consulting, and compliance for business owners and closely held companies. As a member of the AICPA, Brandon works closely on tax policy developments and has recently served as a member of their tax practice committee and as a member of their governing council. To prove that he's normal, Brandon participates in spontaneous dance parties with his family. He thought it was very important that we note that. So at this point, I just want to quickly point out that there is a question and answer section. So please feel free to submit your questions here in the event, and most likely we will get to those at the end, but feel free to submit them throughout the event, and some of them may be answered in the chat, or some may be answered by the presenters at the end. Also in the Q&A section, I've posted a few different resources for you to look over, and we really hope you enjoy this, and I'll go ahead and pass it on over.
Thanks, Sarah. I appreciate the introduction. I think a lot of times as accountants get stereotyped that we're not normal people. So yes, I do like to have spontaneous dance parties, and I will happily admit that before someone outs me on a video in social media. So there you go. Thanks for joining us today. We want to give you kind of an update on what's happened since we last met. If you joined us last week, we talked a lot about the PPP loans, the forgiveness application, and the calculation of how that would happen. But we specified in there that there was movement happening in Washington, D.C. to change everything that we were talking about. Well, luckily they didn't change everything, but they changed a lot of things. And those things are important to make sure that everyone knows about. The changes are good changes for people who have received PPP loans. They're a little less stressful in the urgency to make sure that things happen right away. But overall, the changes that have been made are very, very friendly to people who have received PPP loans and should help to get most, if not all, of the money that you've received in a PPP loan to be forgiven. So let's jump in just a little bit here and talk exactly what's kind of happened at a high level, and then I'm going to let Megan talk about the specific details of this. But last week, last Wednesday, the House took up a vote on, or excuse me, the Senate took up a vote on the House bill that had these provisions in here. The House didn't make any changes, and then they passed it unanimously. And so these changes went to the president's desk, which he signed last Friday. And so now we have this into law, and we're ready to help understand what it means and how to move forward in this. So in the old CARES Act, and what we talked about last week, the measurement period for judging your forgiveness of the PPP loan was limited to 8 weeks. And so now the new changes change this to be 24 weeks instead of the 8 weeks, or until December 31st, 2020, whatever happens first, that 24-week period, or we come to the end of the year. Another exciting change in this for a lot of people is that prior to this bill, the Treasury had said that 75% of your loan proceeds needed to be used for payroll costs. And that was kind of an arbitrary number that was set. They want people to continue to get paid. That's the whole reason for these loans. But this legislation now allows us to take that number from 75% of your loan proceeds down to 60% of your payroll costs. They also gave us an extra little bonus in here that nobody was expecting, but they gave us the ability for companies who have taken PPP loans to participate in the deferral of payroll tax, which is available in the CARES Act. We'll talk about that in just a little bit here. Also, they extended a bunch of the time frames, right? So when they extended the 24-week period, they also extended some of the other deadlines that are there. And so they originally had a June 30th date that you needed to, was the cutoff date to rehire people to get back to your employment levels to meet that definition within the CARES Act for forgiveness. They've now pushed that out and made that to December 31st. And they've also recognized in this bill here that it may be difficult for some businesses to actually rehire people, which was hurting the calculation of the full-time equivalent calculations that happen within the forgiveness application. So they put in 3 specific things to help that would eliminate people, help to make sure that your full-time equivalent calculations aren't being hurt. So one is the inability to rehire an individual who was an employee at February 15th. Now you can't rehire them now. If you can't hire a similarly qualified employee, right, now you have up until December 31st to rehire someone. But if you're unable to hire someone a similarly qualified employee from someone that you had lost, that is now taken out of the calculation. And then the big one is that if you're unable to return to a business, to the same level of business activity because of health restrictions or orders from the government that you can't open up, those kind of things, the calculation will now will reflect that period of time where you're not be able to open up, and so it won't hurt you in your full-time equivalency calculations there. And then the other big change in this is that before these loans were a 2-year loan if they weren't forgiven. Now this law automatically makes it to be a 5-year loan. For those who have received it and as a 2-year loan already, you can renegotiate with the bank and make that happen. But I'm going to let Megan cover a lot of the details on this, but that's the big picture highlights of what we're going to cover as far as the changes for what happened on the PPP side. And then when Megan's finished, I'll take a few minutes to explain some of the changes and updates that are happening with the other economic stimulus programs that are out there right now. So Megan, it's all you.
For sure. So I wanted to start, if you were a part of our webinar last week, I went through almost the exact same slides here, and I just identified the things that have changed. And so if you'll notice on the bottom of each slide here, it says that the red parts are updated legislation, and then we have some green that we are assuming the impact will be because there still is not an updated forgiveness application out on the U.S. Treasury site. And so we expect that there will be some changes that you'll see, but the red parts are what's locked in so far. So first on this forgiveness spending period, Brandon mentioned we have our 24 weeks or December 31st, 2020. So 24 weeks is roughly 6 months. And so as long as you get your loan by the end, before the end of June, before the end of this month, you will hit the 24 weeks first. I think they're going to keep the loan open beyond June 30th because they do have this first, the June 30th is still the end of the loan period happening. There's still available funds. If you don't know that and you haven't received your you haven't been able to receive a PPP loan, please still apply with your bank. Some banks are still accepting, or we have on our squirecares.com, we've got our link for applying through Divvy and Cross River Bank. Those are still available. So, but even if you get the loan by the end of June, your money might not come to you for another week or two after that. So they are locking December 31st as the cap on that period of time. So either 24 weeks or by December 31st, whichever's first. We do have the alternative covered period. All it is allow you to shift to your next pay period. And just for simplicity purposes, so you don't have to sit there and say, oh, we pay every other week. And so we have a payroll that's going to be on January 4th. That's really for December wages. They're just kind of saying, you instead of doing the 1 or 2 day accrual, you're going to be able to shift your period forward and start with a pay period, so that you're administratively, you don't have to do a bunch of extra calculations. This isn't going to be as much of an impact anymore because of the extended to 24 weeks, but it has not had any change to it. So at this time, it still stands. So moving on to the next slide. Our wages. So in our wages, we originally had the limit on your wage to be it was $15,385, which was $100,000 annual, and the 8-week portion of that. And since it's now jumped to 24 weeks, we expect that each employee's wage will now be limited to $46,154, which is the same calculation, except for putting 24 weeks instead of 8 weeks in the portion that each employee gets. And so that, with the extended amount of time, that increases, we expect it to increase the limit per employee of what you can spend for them and have it be forgivable. And like Brandon said, the design is that everyone hopefully will be able to have this fully forgiven. For some, you were already close to the limit, and you were really close to being able to do it within the 8 weeks. But now it's going to be a no-brainer. For others, though, there are still a lot of businesses that are still closed now because of COVID. And so this is extending the window so that they can still take their time. They don't have to feel the pressure of opening their doors unsafely or too early just to use the funds. That was the hope, was that COVID would have recovered before before it has now, when they originally did the 8 weeks. And so now you have more time to spend this money, and hopefully you'll get to use it all. Similarly, your owner's portion will also increase to the limit of $46,154. So it's going to be 24 weeks of your 2019 income. And that is actually will likely result in an automatic forgiveness for almost all of the self-employed portions for the self-employed wages. We're not going to necessarily dig into that unless we have a bunch of Q&A on that. But just so I can re-emphasize, the red here is that it is now 24 weeks. The green is that we are assuming the impact will be that our limits increase, but we haven't. That has not been proven yet. We don't expect anything different. This is what we expect. Next slide.
And Megan, as I jump to that, I just reiterate there that we're all waiting for just further clarification from the SBA with the forgiveness application, and some of the unanswered questions like this. Is it going to be the 46,000 now instead of the 15,000 that we had before? We're not sure when that's going to come. Typical treasuring SBA fashion is to drop those on a Friday night about 10 o'clock at night and make accountants' lives miserable. But when we know them, we'll definitely share them with everybody.
For sure. So if you are not, I'll just make a plug. If you're not already getting our weekly or even more often sometimes newsletters, there is a link in the Q&A where you can sign up for those, so that as soon as we hear about this, we can push that out and you would get that update. And so we definitely recommend you sign up to get those newsletters, in addition to keeping an eye on our upcoming webinars. So All right, so on the employer side, there really aren't any changes at this point in time. You still have your health insurance, retirement plans, state and local taxes, such as unemployment taxes. These are in addition to the wages. So the wage limitation of that $100,000 annualized portion is on the wage only for these costs. These are in addition to that wage. So there's no wage limitation on these costs, but please note that self-employed owners who are reporting, they report that self-employment health insurance on their personal return. They do not get those. They do not get to include those for themselves. If they have employees, yes, they can include them for employees, but not their portion. So there really are no changes on this to this character as of now. So next, for non-payroll costs, these are your business mortgage interest, your rent and lease payments, and your utility payments. The big change here is that this used to be limited to 25% of your total forgiveness. That has now been increased to be 40% of your total forgiveness amount. So those who are really using these funds to operate and stay afloat as a business are going to be able to get that benefit and forgiveness for their mortgage interest and rent and utilities. So that 40% is a big change, and that's a very favorable change, and that's the only change to this activity. Next is a salary reduction. So we have to do an analysis of how much you're paying via pay rate to your employees. The employees who worked both before and during COVID and who are in the less than 100 grand from 2019. So if they're over 100 grand in 2019, we get to ignore them. The SBA is not trying to track whether you kept their salary the same or reduced it. But for anyone who's under 100 grand, they do want to test this because if the hourly wage, so your pay rate or your annual salary changes, it can't change by more than 25%. And so before, you would do a big analysis step by step, and you would have this caveat that you could do the restore their wage by June 30th, and now that wage has been moved to December 31st. That restore their wage by December 31st, and then you will have more time to make this analysis be less or no impact. We do expect, I mentioned that we're going to normalize if they calculate that there is a difference, meaning you were paying them $20 an hour, now you're paying them $13 an hour, they're going to take that difference that it comes out with in the calculation, and they're going to apply it to probably the full 24-week amount that you're claiming for wages, and you would have a reduction for the 15 minus, I think I said 12, I forget. Anyway, the 15 minus 12, that $3 an hour difference, that would be a reduction to your forgiveness. And so you really don't want, especially with the extension on things, you really don't want to fall into this problem with the salary reduction, because even if you have a bunch of costs that you can be forgiven for, this could still reduce it and make you not be fully forgiven. And so you want to make sure that you're focused on this reduction analysis, as well as the next one we'll talk about in a second, so that this is not a problem. And we as well as the AICPA have forgiveness calculator tools that can help you analyze that and make sure that you don't have any employees that this is going to trigger on. And so the good news is we have plenty of time to fix anything that's still under the threshold, but make sure that this doesn't hurt you. Next, employee headcount. What we have with the headcount is they probably will make some changes to some of this calculation because of the larger period, but what they're going for, and so what they're going for isn't going to change. What they're going for is what is your average headcount and your FTE, your full-time equivalent. And if we take that average, you're gonna figure out what that is as of during the 24-week period. And if somebody's working full-time, you can't give them more than 1.0. You can't give them more than one full-time person. They're going to be limited to one. You can do an analysis of how many hours someone's working, and they can be a 0.75 or a 0.67 or a 0.3 for their number of hours out of 40. Or you can simplify and say, well, if they're full-time, they're one. If they're part-time, they're half. And so you can choose whichever one makes more sense to you. But we're trying to say, what is your full-time equivalent now versus a comparative reference period? So you get to choose. And what I expect is there may be more choice, maybe changes to the reference periods, or maybe there'll be more reference periods you can use. But right now you can say, well, I want to look at last year, February 15th to June 30th of 19. So if you've been a growth company, you would want to choose that. You'd want to say, yeah, I want to use last year because I've been growing in the last year. And so even if I had to cut back my workforce, you maybe didn't cut it back even past what you were a year ago. So February 15th to June 30th of 19 is one option. You can just compare with January and February of this year, so pre-COVID, where were your FTE numbers? And then if you're seasonal, you could choose a consecutive 12-week period between May 1st and September 15th of 2019 last year. And the idea is that you're trying to get something in comparison that so you're comparing apples to apples as best as possible, and saying, okay, well, this year we have 50 full-time equivalents. Last year we had 53. Now your goal is to try to get up to 53 by the end of the period, which originally was 8 weeks. Now that's been extended, and we'll jump to the next slide to talk about that. If you are, I actually am going to do these two groups backwards. The safe harbor was what I was just talking about, is where you can restore your FTE levels by December 31st. So you have time to get your business back up to what it was, your workforce back up to what it was. Going beyond isn't any benefit, but you want to make sure you're at or above. And so your strategy there is getting the right comparative period and knowing where you stand now, so that you can kind of have a plan for getting there. You know, some people only have 4 more months left because they were right now ready to hit the 8-week period, and so they need to be working on their getting their FTEs back up. The top section of the reduction exceptions, you do get to have exceptions for those employees who you cannot rehire. But you have to have these situations. You have to have made a good faith written offer to rehire an employee, and the employee has to have rejected it, and you need that documented. You could have fired someone for cause. Somebody could have voluntarily quit, or they could have voluntarily asked for reduced hours, and you said yes to that. So the idea is that these things are kind of outside of your control, and so you won't be hurt for those exceptions. One thing to note is on that made a good faith written offer to rehire. On the next slide, we do have to document that you I don't know if I put it there. Anyway, you do have to document that you notified the unemployment office that they rejected an eligible offer of work, because that's now if they have a different job, that's you don't have to document that to the unemployment office. But if they're on unemployment and you're aware of that, you have to say, yes, I told them that I told the unemployment office that I tried to rehire them and they said no, because the point of unemployment was not to all of a sudden give everybody a bunch of money for not working. It was designed to help bridge the gap between businesses aren't able to hire people. Let's keep everyone afloat. As soon as those businesses are ready, by the way, here's PPP funds to help the businesses get ready faster. Now let's go and get these employees rehired. And so that was the point of it. And we're hoping that that we get as many of these people off of unemployment as possible. So other documentation that you can read through on this slide, no changes here yet, but that's mainly because we haven't seen the updated forgiveness application. And so we will make updates to this as those come along.
Yeah,
go for it.
For a minute.
Go for it.
And when we talk about the FTE reduction exceptions, this is where the new changes also come in the law too, right? Where if you're unable to hire an employee, we talked a little bit about that. If you're unable to hire them, it's not going to hurt you in this FTE reduction. And also, if someone's left and you've got a highly skilled or highly qualified position and you can't find someone who to replace that specific position, that is now eliminated as one of the exceptions in the headcount here, so that it won't hurt you as well. And then again, just if your business has not been able to open because of COVID still, the reduction in the headcount here will also not hurt you when we do this calculation in the forgiveness process. So those are just some additional exceptions that got added in by the Act.
Okay. Awesome. Well, I'm ready to hand it off to you, Brandon, and we'll get ready to answer the Q&A stuff after you go through these additional programs. Okay,
great. So one of the things that's not necessarily a PPP related, but it's kind of related, I guess. Part of the CARES Act allowed companies to elect to defer payroll taxes, not pay them into the government, so that they could keep cash flow on hand during this period and keep the business open. So previously, if you had received a PPP loan, this option to defer paying the payroll taxes was not available to anyone who received a PPP loan. This PPP Flexibility Act changes that now to allow companies to maintain cash flow to keep the doors open, so that even if you have received the PPP loan, you now have the option that you can participate in this payroll tax deferral under the CARES Act. And so what that does is it allows you to take the Social Security tax payments that you pay on your employees' wages. So the 6.2%, that's the employer portion. That's what you're eligible to defer. So if you do defer that, they give you 2 years to make those payments. You have until the end of 2021 to make the first 50% installment of the 2020 wages. And then you would have to make the other 50% of the payment due at the end of 2022. So it doesn't eliminate, it doesn't eliminate you having to pay these payroll taxes, but it does allow you to defer them to keep cash flow in hand, to keep businesses operating. And the change is just that, it allows the companies that have taken PPP loans who are still experiencing potential cash flow issues. This opens up an option for them to do that. Kind of it's related to the PPP terms, but it's a whole different way to look at it from that perspective. So let's move to a couple of the other big stimulus package items that were out there for everyone. So the EIDL loans, this has been a big topic for a long time. From the SBA, it's the Economic Injury Disaster Loans. As soon as the nation was placed under a nationwide emergency from President Trump in March, it opened up the ability for the SBA to provide economic disaster loans. The rules are similar to what the rules were for applying for a PPP loan. It was only available for employees or for companies that had 500 employees or less, and you had to be in business as of January 31st of 2020. The purpose of these loans was to be used for working capital to cover day-to-day expenses in the wake of, economic downturns and potential cash flow issues. So kind of maybe just some context around this here so you can kind of see where things are at this point, and an update for you. Originally, the CARES Act funded this program with an additional $562 million. Those funds were claimed in just a little over 2 weeks. And so in the second round of funding, where the PPP got extended with more money allocated to it, an additional $60 billion of funding was made available to these economic disaster loans. And in looking at the SBA numbers as of June 6th, so last Friday, they have now issued nearly $80 billion, not necessarily issued, but they've approved $80 billion for loans. So some businesses may still be in the process. I know that we're working with people who are in the middle of working with the SBA, figuring out, the actual loan amounts and how these will work. So that's included in that $80 billion. It's not actually funded yet. But now what's happened is that the application has basically been shut off for anyone except for an agricultural business. That's one of the big areas that they want to make sure that they're providing assistance to now at this point. So if you haven't applied at this point, it's probably too late. If you have applied, you may have either heard back or you're still in a waiting line to see what's going to happen. They made some changes to these loans. I don't think they anticipated how big of a program this was going to be, that people would be trying to jump in. And so they opened it up and people jumped in, and they've had to do some refiguring here. So the original terms on this, that you could have received up to a $2 million loan. It's a 30-year loan, a 3.75% interest rate. If you're a not-for-profit, it was knocked down to 2.75. You could defer the principal and interest payments for the first year, so you wouldn't have to make those. And then if your loan was over $25,000, the SBA would take a security interest in any of your tangible or intangible personal property, so that if you defaulted on the loan, they would have recourse to it. And then in the original terms, if you had a loan for over $200,000, owners of the companies were asked to do a personal guarantee on the loan in addition to that security interest there. But because of the popularity of it and then the flood of applications that they got, they realized that after the first 2 weeks, they needed to reduce the maximum loan amount. And so the maximum loan amount on these now was $150,000. Nothing else really changes except that personal guarantee goes away, because none of these loans are over $200,000. So the other hard part with these loans is when people jumped in and made these applications and have started to receive the loans, there's been some surprises that have come back when they actually look at the loan documents and say, what can I actually use these loan proceeds for? So if you recall, in the PPP loan process, you could use them for the payroll costs, for mortgage interest, rent, and utilities, right? EIDL loans can be used for the same thing, but if you applied for both of those loans and you got both of those loans, you needed to separate it, because you couldn't use EIDL funds for the same purposes as PPP funds, or else you would be disqualified from receiving those PPP funds and have to repay that money. But as people have taken EIDL loans and they've seen this come through, There are some specific things that I think are important for people who are in the process right now of looking at these, who may have documentation or whatever, or have maybe even taken them at this point. But there's some specific uses in the loan of these loan proceeds that have been prohibited. And so I want to just highlight these non-eligible expenses. So dividends and bonuses. So dividends to owners or shareholders, bonuses to employees, you can't use the idle funds for those purposes. So also owners' draws. If you're taking a distribution from your company, the idle funds cannot be used for that purpose right there. And then if you have loans that you have personally made into a company that you own, you can't use these idle funds to repay yourself loans that you personally made there. Additionally, this question has come up a lot, like, can I get this idle loan and can I either buy new equipment or expand what I'm doing in my offices? I want to do some sort of remodel. I need to buy this piece of equipment. The idle loan is not available for that because it's not a day-to-day expense that the idle loan was put in place for. And again, if you have physical damage on your property or equipment or anything like that, repairing or replacing that is not considered an eligible expense for these idle loans. You can't use it to refinance long-term debt, so you can't take it and pay down something or change an interest rate on something else, right? And you also can't use it to pay down or pay off any federally backed loans unless you owe money to the IRS. That is the one exception that they'll let you use to pay that right there. And then any relocation fees, if you're trying to move your businesses to a different location, idle funds are not allowed for that. There is a specific provision, though, that you can ask for them to reconsider that relocation if needed. If something drastic were needed there, they might change their mind on that to use those there. So that's the idle. So the other one that's out there, you may have heard something about it. It's not really available yet, but it's the Main Street Lending Program, and this is outside of the SBA and outside of Treasury. This is directly from the Federal Reserve. They were given specific powers in the CARES Act that they could come up with a program to help businesses and to help the small and mid-sized businesses to stay open, to help the economy continue to function in some sort of level. So it's targeted for companies with less than 15,000 employees or less than $5 billion in revenue from last year. Just yesterday, as we were in the middle of finalizing this, they updated the program, trying to make it more appealing for borrowers and banks to use. They need to get banks involved in this to help, and so the banks will be the vehicles, just like the PPP loans were, to make this work. And so they're trying to put it out as to what's available for them. We'll go over some of the terms in just a minute here, so you can see it. But it's important to note, it's like this has been in the works for 2 months. It's not open for lending yet. They've taken the last 2 months basically to try to iron out the program, make it work, get banks on board to do it. Right now, the anticipation is that perhaps next week this will open up to have options for people to look at. There are the loan that you can receive, the limit of the amount of loan you can receive is going to be subject to the financial condition of your company. There are maximum loans and minimum loans that are out there, but the actual amount will be determined on a review of your financial statements. And again, just like we saw with the idle loans, these loan proceeds are going to be restricted on what you can use them for. And there's certain certifications that you have to make as a borrower to make these here. So from a high level, just want to show you what these options are. The Main Street Lending Program is broken into 3 different loans. So they call them loan facilities: a new loan, a priority loan, or an expanded loan. Each of the loans have the same term. They're 5 years. One of the changes that they made yesterday is that principal payments on the loans can be deferred for the first 2 years. Originally, it was for the first year you could do that, but they have changed that now that you can defer for the first 2 years. And then you can see the repayment schedule on the loan in years 3 through 5. If you haven't paid any principal down, you're required to pay 15% of the loan back in year 3, 15% in year 4, and 70% in year 5. Again, the interest, that's also deferred for the first year. They haven't changed that to match 2 years, but they'll defer it for the first year. One of the big questions right now is what the rates are going to be on this, and they've come out and said yesterday that the LIBOR rate, the 1 or the 3 month rate, plus 300 basis points on there is going to be what the rate is going to be. And so if you look at that, if you look at the 3 month LIBOR rate currently today, it is 0.31%, right? And then you'd add another 3% to that, so it'd be 3.31%. But that's going to be adjustable throughout the life of the loan on these loans. And so if the LIBOR rate goes up, your interest rate is going to go up as well. All right. And then you're going to look at the loan sizes that are available. So they've lowered it. It was originally, well, there's been 2 adjustments to this. It was originally a $1 million loan was the minimum limit. Then they dropped it down to a $500,000 loan. And yesterday's announcement dropped it down again to say, for that new loan facility or that priority loan, the smallest loan size that you can get is $250,000, and you can see that those change depending on which loan you're going for. If you need an expanded loan, you know, there's options to get even more money right there at that point. The thing to know when we talk about the amount of loans going to be determined on the financial condition of your company right there. They're going to look at what your debt ratio is to your EBITDA number. So that's earnings before interest, taxes, depreciation, and amortization. So we get all excited about that as accountants and what those numbers are. But in order to qualify for these loans, your earnings ratio to your debt needs to be at least 4 times what your current debt load is before taking this on. So that may hurt some people. It may help some people who are looking at additional ways to get funding. And that's really all this is an additional way to get funding to keep your businesses open here. A few other details right here. They've been really trying to get the banks on board to make this work. And so what happens is that the bank is going to make the loan for the determined amount, and then the Federal Reserve now is going to, with this new update, buy 95% of that loan and back that on their own, and then the banks would only have a 5% of that loan exposure risk. And so that's dropped down. Originally it was up, you know, 15-20% the banks were going to do, and they've, in order to get the banks to participate in this, they've tried to limit the exposure to the banks on that. And so we'll see how that falls out at that point. But the Federal Reserve is basically guaranteeing to buy these loans back when their options are there. So you can prepayment. You can make a prepayment. So even though the principal and interest is deferred for the first year and the principal for the second year as well, you can make those payments, because looking at that payment schedule, some of that might be a little hard to swallow with a 70% payback in year 5. So you can definitely make prepayments on that to help that out if you needed to get one of these loans. Again, we talked about the business size limits, 15,000 employees or fewer, and then our revenues in 2019 of less than $5 billion at that point. And then there's fees and transactions that apply in this, right? So it is an option that is becoming available for businesses. This is mainly targeted at businesses who could not qualify for the PPP loans because of their size. It's got, you know, it does not have any of the forgiveness amounts or ability like there is in the PPP program. And so this is just another option that's out there. Again, hopefully it opens up soon if people are interested in it. We're watching and waiting, and this just keeps getting pushed back and pushed back and pushed back. Yesterday's announcement signaled that they were getting close to actually kicking this one off the ground. But I think it's also important here when we talk about this, we talked about their certifications that go on here as well. And I think we need to make sure you know what those are when you're looking at this program here. So you have to certify that you will reasonably maintain your current payroll levels and your employee count for the entire term of the loan, so the 5 years. Obviously, like a lot of things happen in 5 years, a lot of things happen in 2 months, right? And so this is kind of we're taking you at your word kind of a thing right here. You also have to certify that you can meet your current obligations for the next 90 days and that you don't expect to file bankruptcy within the next 90 days when you apply for this loan, right? The other interesting limitations on this is that you can't take these proceeds of this loan and use it to pay down other debt. The wording in this program says that you can make minimum payments on other outstanding debt that you have, but you can't pay it down or make any advance payments. You can only make your regularly scheduled payments on that debt that's there. And until that this Main Street funding loan is paid in full, and then you can pay back in full, then you can pay down your other debt that's there. So they're basically making sure that you're going to keep operating and make sure they get paid back as well in that process. You also certify in this and promise that you're not going to cancel or reduce your current line of credit limits or any of your credit cards. And again, you can't pay down your line of credit, but they're also saying that you can't get rid of it or you can't reduce it. But you can make regularly scheduled payments on it that you make there. And same thing with your credit cards there. And then the other kicker in this one is that there are some restrictions that they put on you as far as compensation rules, repurchasing stock, issuing dividends in your company. There are restrictions in the CARES Act that you have to follow. It's probably not. It's probably too deep to get into today to talk about, but it just is something to consider when you're looking at it there. Just kind of what we learned with the IDO program is that people jumped into it without knowing what the restrictions are, and so giving a heads up to what some of these restrictions are in the first place can help you do some planning and strategizing as to if this is a good option or a needed option, or how to operate if you do go through and get one of these loans. So, good. All right, that's a lot of detail right there that's going on. So Megan, let's open it up to some question and answer and see if we can't answer some questions.
Great. So I've got us into a few different buckets as questions have come in. So let's go ahead and start with headcount. So one question we have is, what determines a seasonal employer? So we do educational software for teachers, and that means our staff is reduced during the summer. Does that qualify as seasonal? My answer to that would be yes. That's kind of where we are, since we are in the summer right now. Your staff probably has reduced, and so you want to make sure you're getting that comparable period. And so as a seasonal employer, you'll be able to pick that comparable period from 2019 to 2020 to make sure your actual 24 weeks is apples to apples compared with last year. And so so the answer is yes, that would be an example of a seasonal employer, and you would want to make sure you've got that correct comparable period when you're looking at your headcount comparison. Anything to add, Brandon?
No.
Okay. Awesome. Our next group of questions, I want to jump into some of the costs. So one question is, if the employer does not contribute to retirement, dental, or health, but the employee pays that out of their wages, can that be included? The answer here is that it already is included by having their wage be there. So no, the employee's portion of those benefits are going to be are already included in their wages because it's something you withhold from them. And so because it's already part of their wage, you cannot then add it again into the payroll costs. The employer portion, so if you're matching any 401k, or if you have contributions to their HSA account, or if you are paying any portion of the premiums for those insurances, then those are the portions that you can include as additional payroll costs beyond wages. Next question is, has there been any clarification yet as to what is considered transportation or other utilities for the non-payroll costs? Brandon, have you seen anything on that?
No, that's probably I would say that's the most common question I've gotten since this bill was signed into law on Friday, is that people have asked that same question. What does transportation and utility really include at that point? So they did give some clarification on transportation and utility costs for self-employed individuals in the application process. They have a kind of a frequently asked question, interim final guidance kind of deal, talking about that for self-employed individuals, but they haven't specified that yet for businesses as a whole, what that means. So it's one of the, we keep hearing that there's anywhere from a 20 to 30 frequently asked question page about these new rules that's supposed to come out. And so we are anticipating that that will be in that guidance.
Awesome. Yeah, so we're, hopefully that will come soon. What about accrued interest on other business loans allowed as non-payroll costs? So in the non-payroll costs, they do specifically allow for interest on mortgages. Basically, they say any loans that are on real or personal property. So that would include vehicles, equipment, things like that. And so though the interest on those loans is included, line of credit interest is included. And so if we're talking about other interest beyond that, we do not have clear guidance on that, of whether that's forgivable or not. We think that there may be some banks who are more lenient on that than others, but as an overall, I would say that with the changes to being 24 weeks, I would think that allows you to use almost all, if not all, of your forgiveness is tied to payroll, which pushes out kind of the bottom of the non-payroll expenses, not even needing to try to push that through. But
yeah, that's a really great point, Megan. Like these non-payroll costs, we can get caught up in those, and obviously that's made it more beneficial there. But when you look at what's happened, is that they've given you basically in a PPP loan 10 weeks of payroll costs in the PPP loan, but now they're letting you count 24 weeks of a payroll period to offset it. So hopefully that 24 weeks will easily get you to the point where you can match those same payroll costs that you got loans for, and not have to worry about how close you're cutting it to that 60-40 split.
Yeah. Okay, so then let's jump into some of the forgiveness questions. So on the reduced wages, we have a question of whether it's dollar for dollar or percentage based on the forgiveness calculator. And so there's on the reduced wages, it is a dollar for dollar reduction. So let's say you paid somebody $50,000 as a annual salary. Now you're only paying them now you're only paying them $30,000. You get to have a 25% reduction without any effect to you. But that difference of their 75% payroll of what it was, so 75% of 50,000 is 37.5. If you're only paying him 30 grand, then that 7,500 difference is going to be a reduction to your forgiveness. So That is a dollar for dollar. The headcount side of it, so the FTE equivalent, that is a percentage basis. So if you have 100 employees before, now you only have 80 employees, FTEs, then you would have a 20% reduction to your forgiveness. So they're both handled differently, and there is confusion around that. So that hopefully clarifies it a little bit more for you. Okay, next question is, we received the PPP. We should be able to meet the forgiveness amounts using just the 8 weeks. Can we file for forgiveness early? Like, can we proceed with the current application? Do we need to wait, or can we at least do it early? Do we have to wait the whole 24-week period?
So that's a really good question, and that's one thing we probably didn't bring out in here is that the new bill, the Flexibility Act, allows companies to choose whether they want to keep the 8-week period or they want to move to the 24-week period. So if you know that you're going to reach full forgiveness at the end of the 8 weeks and you don't have an issue, like going ahead and starting the process now to get that done kind of gets it ahead of the pack, right, and gets it done, because there's going to be lots of people who are waiting. The one thing that we're waiting on is updated application and the updated application for forgiveness itself, and the applicable guidance that will be updated with that as well. And so if you can meet it in the 8-week period and not have to push it to the 24 to make sure you meet forgiveness, you don't have to wait. You can make that decision and go ahead and apply for it. The other thing to note is that you do have 10 months to do the application for forgiveness after the end of the covered period. So if your covered period's ended at the 8 weeks, you can start to apply as soon as the application's ready, but it doesn't have to be done right away. It can be done up to 10 months later.
Great. What about in between that period, Brandon? Like, you're not 8 weeks, maybe you're 12 weeks. Will you be able to just say, okay, I made it, and work with your lender to do the forgiveness application then, or do you have to wait 24?
So I know that's one of the questions that has been asked a lot back to Treasury, to say, hey, if we get in this at 12 and 14 weeks and we're there, can we just call it good and go for it? The anticipation is that it could happen. They could allow that to happen, but until they're willing to give us the answer on that one for sure, then the safest bet would be to wait until the 24-week period is over to do it, unless they give us the go ahead to say, yeah, we know you've met it, at 12 weeks, move ahead.
Yeah, and based on what I'm seeing from some of the lenders, it seems like they're gonna be ready for forgiveness come the end of June, sometime in July, because of the 8-week people. They're gonna be ready for it, and so you may be able to. It may be up to the lenders of when they'll accept that to come in, because yeah. I think the lenders will be able to have a say there. So whoever your lender is, you'll want to possibly work with them on that. Okay, so the next question is, if you maintain all of your employees and are able to maintain profitability during this, is the loan forgivable, or does your profitability make you not eligible to be forgiven?
The forgiveness calculator and the rules themselves don't bring into account profitability in this whatsoever. It's all about what are the uses of the funds. The program was intended to keep people at work, keep people getting paid, try to keep the economy going. So they have not taken into account anything related to what your income was, what your profitability was. It's all about, did you use the money for what it was supposed to be used for?
Okay. Also awesome. So we kind of talked about this before the webinar, but we have a question on that, the cliff of do I have to spend 60% of my loan amount on payroll costs in order to be forgiven for any of it? Because there has been some confusion there over time.
Yeah, so that was a big piece that came out after the bill was passed that said, hey, wait a second, we may have drafted this wrong to say if you don't have 60% of payroll costs, you won't get any forgiveness. The Treasury came out, actually, the Treasury Secretary came out yesterday and specifically said they have the power to make the change, and they aren't going to make it a cliff. They will make it, pro rata. So if you happen to be at 55%, like then you'll have 5% of the loan that could not be forgiven.
Right. So they're gonna take it and say, whatever you didn't get, it'll probably reduce your non-payroll costs as well that are forgivable, but you still get as much as you spent, right?
Yeah.
Pretty much. Okay. Next question. What about timing wise? So after we've used the PPP funds, but before the 24-week period ends, what happens if we have to lay off employees because it didn't last long enough? Do we have any insight into that?
No. This is, we talk about, having until the end of the year to bring your head count back up to meet whatever measurement period that you choose to get in there. That's the real guidance that's there. The question is a very legitimate question, and one that I have not seen the answer to yet, and maybe will be addressed coming up here soon. I don't know if you've seen anything, Megan.
No, I would assume I assume it's going to be in company with the ability to get forgiveness part along the way versus waiting the full 24 weeks.
Yeah.
If it's a hard 8-week or 24-week call you have to make, then there may be some people who have to do both calculations and decide which one's better for them.
Yeah.
And with understand there may be some forgiveness or some reduction in forgiveness on either method. Not enough costs in the 8-week, but then you have enough costs, but you have to have some of it reduced in the 24-week. I hope that doesn't happen, but that could be the case. We don't know the answer to that one yet.
Right.
And then another similar one is if we're calculating FTE on December 31st, but it's in between Christmas and New Year's, and there's a lot of people who are off during that time. Is that going to affect their FTE count by having people not working or not being paid during that time? Any insight there?
Well, that's going to depend on if they have, holiday and vacation pay that get added into their 40-hour calculations, right? Or whatever hours that they work for calculations at that point. So that's one aspect to look at there. And there's probably, as with everything that we're learning in this program and the calculations, there'll be some variables that we take into account to help process, what's the most accurate number of a full-time equivalent there, but which, guidance is everything these days. We wait for Friday nights like it's a football game or something in our world, but we don't know exactly what that looks like from that perspective, because they just barely made that change to the end of December rather than being the end of 8 weeks or June 30th.
Okay. Next question, because I want to wrap things up here if we can soon. We have a question on self-employed. Self-employed owner received about 26 grand on the PPP loan, which is less than the limit, which is good. The bank told me originally 75% was forgiven, but now will that mean all of my loan will be forgiven? And I can speak to this. This is something that we have to wait on the forgiveness application to confirm. But we do believe that, I mean, you received a loan for 2.5 months worth of your 2019 self-employed income. And so by extending the 24 weeks, that's well beyond 2.5 months. And so we do think that the self-employed portions will be fully forgiven, but we don't know for sure on that. It hasn't been proven. We do expect it.
Well, until we see it written in a guidance, like we're guessing, right? And like
Right.
It makes common sense to make it that way, and I think it's the feeling of the entire community saying, hey, this totally makes sense, but like we just have to hold our breaths and say we think that's what it's going to be, because they might decide to change their mind.
Right. Okay, so then we have a few idle loans. So questions. So if I get an idle loan, will it reduce the amount I can get on the PPP loan?
No, they stand independent of each other.
Okay. Next, if we receive the idle loan, can we use it to pay off the PPP loan?
No. So if you remember from the discussion we had in there, was that using that to pay down debt is not an applicable use of the idle fund. It has to be day-to-day expenses. And if you've gotten a PPP loan, you'll want to use the PPP loan specifically for the payroll and the rent, utilities, those kind of things. Other day-to-day expenses that you have, you'd use with the idle loan at that point, but you can't use it to turn around and pay off the PPP loan, because hopefully your PPP loan is going to be forgiven and you don't have to repay it.
Right. Then the next question is, can the grant amount of the idle loan, the 10 grand grant, or however many employees times up to 10 grand, can that be forgiven in addition to the forgiveness for the PPP loans?
So that the amount that you receive in a grant actually reduces the amount that can be forgiven in the PPP loan. In the calculations that you go through in the application process. If you've received a grant, you take what you've received and subtract that from the PPP loan that you received to get to a forgiveness level on that application.
Okay, so it's not a separate analysis. Basically, it's part of your PPP forgiveness that it considers the grant. Okay.
Yes.
The next, at this point, the last question is, do we know what the oversight is on the usage of the idle funds? Was when you listed all the non-eligible expenses, were those to figure out the amount of the idle loan, or is there actually an oversight or a reporting on how you use the funds?
It's kind of I'll try to make it a short answer. So the idle loans are different than, say, receiving a regular SBA loan that, gives you money and says, go ahead and, run your business, do acquisitions of equipment or whatever you need to do or whatever. The idle program specifically is going to ask for an accounting of the funds. A lot of the recommendations that are out there is that if you receive an idle loan, put it in a separate bank account, and so it's easily traceable, and you can be able to prove to the SBA what you're using the funds for, right? So, I mean, it's a 30-year loan, and originally it was that term because it was, up to a $2 million loan or whatever, and so the tracking of that of those funds for 30 years for the repayment and the use of them would have been, a big process in that. But the idle program itself asks for an accounting of the funds on at least an annual basis to show what you're using the funds for. Repercussions of not using the funds for the proper thing can be, you know, an immediate call of the loan and having to repay it right away, along that purpose there. But there is an accounting process that you should undertake with an idle loan so that you can send that reporting to the SBA on at least the annual basis that they require.
Okay. All right. And we're definitely available and willing to help anyone who needs some help deciding that accounting process. That's what we love to do. We do not have any more questions that have come in, so I think we can wrap this up. And thanks to everyone for attending today, and hopefully yourselves buckled in for the additional roller coaster ride that I'm sure is still ahead of us. So let us know if we can ever do anything to help you out. We have a lot of resources on our squirecares.com website. And any last comments, Brandon?
No, I just want to say thank you for everybody for joining us, and we are here to help. So, if you have issues or questions, feel free to contact us.
Great. Thanks, everyone.